Well, good afternoon, everyone. It is Friday, June 16th. It's time for This Week in Crypto. I'm Dave Weisberger, the CEO of CoinRoutes, and let's look at the markets. Well, if you only woke up and looked at the market on Friday last week and today, you would say in the crypto world, very little has happened. Bitcoin is trading a little bit above 26, Ether's trading in the mid 1700s. You'd say, not much happened. Well, of course, that's not the truth. The truth is during the week, right after the Federal Reserve announcement, for some reason, there was a slight depegging, and I mean very slight depegging, to the point where we almost can't call it a depeg of Tether, some rumors that ran around, and $1,000 down candle in Bitcoin with comparable moves in Ether and other cryptos that, as of today, have been erased. So we've had yet another one of these whoopsie daisy, oh, just kidding kind of market moves. Well, when you're in a range, as we keep talking about every week, that sort of thing is bound to happen. But this week, we've had a lot of news. To be clear, we're going to talk through each of these. We want to talk about the Hinman papers. We want to talk about the SEC's non-response to Coinbase, despite court ordering them to do so. We'll talk a little bit about the Binance case, the SEC proposal put out by the House, the Prometheum exposure and embarrassment black eye for the SEC. And then we'll conclude with a conversation about the BlackRock ETF. But before we get started, I want to make one thing particularly clear. I've said this before. I'm happy to say it out loud because I think it's true. What we have seen recently after McHenry and the Finance Committee, working with the Agriculture Committee, proposed to not allow regulation by enforcement and putting out 168 thoughtful pages of a blueprint for regulating digital assets, we saw a hurried approach by the SEC. We saw panic and desperation. The Binance case may very well have been ready, although the timing of it, the next business day after that was released, was curious. But the Coinbase suit was ill-conceived and probably as bad strategically as Napoleon going into Russia. Because essentially what we saw is the SEC, who have many hardworking staffers that do an incredible job, have to push something out without checking. And so we know this because the list of securities on both filings were different. And that's a real problem. Then we saw congressional committees and a hurriedly scripted approach to have this Prometheum firm say, oh, we don't need new crypto laws, which was so laughably inept that it makes you think that they really, really are reeking of desperation here. Now, I don't know why they'd be desperate because they still have the political power. They're still pushing thousands of jobs potentially out of the United States. But well, let's talk through the news. So first, what do we want to say about the Hinman documents? Well, the first thing is, as you would expect, there's no smoking gun. There was nothing in the documents that said XRP isn't a security and we knew it. Yay! And so XRP dropped a bit. But it did show something very important. It showed that the government, that the SEC knew there was no clarity. There are many email exchanges saying that. It showed that they understood that in order to preserve potential future power, they should stay vague. Now, that is problematic because it essentially proves the intent to not clarify rules. Yet, they keep making public statements that the rules are clear. Guess what? Can't have it both ways. The rules are clear as mud. Actually, probably mud is clearer because you can at least see things through it. In this case, nobody knows what's a security. Nobody knows what could be. And more importantly, they don't have rules that work for them. And we've talked about that before. Second, the Coinbase was had the district court say, or the third, whatever, I can't remember which court it was, said that the SEC had to respond by Tuesday to a motion to a writ of mandamus. And their response was essentially to say, nope, we don't have to respond. We don't have to say anything. We are who we are. You are who you are. And we're going to keep going and doing what we're doing. More or less, that's what they did. Unfortunate, to say the least. But clearly, we're in a situation where preserving their own potential to regulate is more important to them than getting clarity in the industry, no matter what the stakes are in the industry. The Binance case. We had a sort of ruling, not yet full ruling, from the judge on the temporary restraining order to freeze Binance US's assets. And basically, the judge said, you guys should work this out. Now, I said last week that I think that there is a serious due process problem here. I still believe that. I think it is absolutely ludicrous that the SEC is broken with decades of tradition to try a potential offender in the court of public opinion rather than going to court, rather than going through their normal means. But we'll let that play out. I don't have a lot of, I pretty much have nothing to say on the Binance case. I have no inside information there, no particular insight, and it looks like the charges are serious. My concerns are with the Coinbase case and with the threat to the entire digital asset industry in the United States writ large, because that is literally what's at stake. So let's talk about the proposal from that Warren Davidson brought out into the congressional committee to change the governance of the SEC. I don't believe it's going to pass, but I do believe that there's bipartisan support, at least in the actual heart of hearts of many of the Democrats that are sitting in Congress and the Senate. The proposal, for those who haven't read it, is simple. Right now on the SEC, whoever is the party in power gets to nominate 2 commissioners and the chair. So they have a 3-person majority on a 5-person commission, meaning the party in power can, if they choose to do so, use political power to pass through what they want. Now, in the history of the SEC, the vast majority of rule proposals are compromise proposals with various factions in the industry and the SEC, subject to intense public comment and revision, subject to hundreds or thousands of staff hours working through details that generally get approved, before this SEC anyway, generally get approved by a 4-1 or 5-0 majority. There have been multiple times when there have been very limited dissents, and the dissents are generally on a technical matter, and they generally have to do with something that individual members feel strongly about. Most famous one being Paul Atkins' dissent on Reg NMS, which, while I agreed with most of his logic back then, the fact was it was needed to break an oligopoly, more or less, that was controlled by the New York Stock Exchange in order to bring electronic trading into being. One could argue many of the things in Reg NMS have outlived their usefulness, and today, if it were voted on again, I would agree with Paul to dissent on it because it's no longer necessary. But that's an interesting aside. The fact is, a 3-3 membership would force compromise, would force consensus, and eliminate politicization of the SEC, which I think would be undeniably a good thing for the financial markets. And frankly, I think most agree with that. The problem is it will be perceived as a direct attack on the authority of the administrative state under the Biden administration, personified right now by the current chair. But I don't think that that's why people would support it, many people. But because of the perception, I don't think it goes very far. But it is a very good idea. And it's one that would help our markets be better, because politics and markets don't mix. And it doesn't matter whether it's Republicans in the ascendancy or Democrats in the ascendancy. But we shall see. What's interesting, however, is it comes at the same time as clear malfeasance was demonstrated by something that it's almost incomprehensible how dumb it was to put the CEO of this company, Prometheum, as a witness to say we don't need new crypto regulations, in addition to being eviscerated by members, by at least one particular member of Congress in a very famous now 4-second or 4-minute clip, where Prometheum had to admit that virtually none of the important tokens that people trade in crypto they can support, and that there is no path. And admitting that the only definition of what they can trade is illustrated by enforcement actions and commentary as opposed to rules. The fact that this particular company has a payment chain dating that is clearly traceable to Chinese corporations, that they have no experience, that there's literally nothing there, and that nothing in their order would allow Coinbase to continue to operate is just farcical. But yet, here we are. I don't know what they thought, but one of the important things that's interesting here is going to be that I guess it kind of exposes the fact that there are people within that party that in the anti-crypto army that devalue public opinion, that devalue the ability of individuals who might not be accredited investors from actually having fact-based opinions and providing good data. Because as soon as the Twitterverse got into this, it took hours for all of this information to come out. Now, it's kind of funny because I'll bet in their personal life, pretty much all of them use Amazon reviews, use Google reviews, or Yelp reviews to decide what to buy in terms of products, to decide what restaurants to go to. But none of the people writing those reviews are accredited investors. So why am I talking about it, accredited investors? I'm talking about it because the real problem in the cryptoverse, in the notion of there being clear laws, is that there is no way for crypto tokens to actually get registered if they are proposed by a decentralized organization, if there is no corporate structure, if they don't have financials. Those tokens are necessary for the operation of the network for several reasons. First of all, developers are compensated that way. Second of all, the networks are generally secured by miners or some other method. And third of all, gas fees on the network are generally paid in the native token because it's the easiest way to do it. But lastly, communities of users are incentivized to use it and give feedback and vote on the network. And that creates a good reinforcement loop. Now, why am I mentioning that today? I'm mentioning about it today because I think that people need to understand what it means. And what it means is something very important for a new technology that everybody is talking about called artificial intelligence. What is the biggest problem with AI? The biggest problem with AI? Well, it's data. It's that if you don't know the data is good, or if it is potentially skewed, you could get completely wrong answers. It also means that you need to secure that network to know that the data is not getting corrupted. Well, what is blockchain technology extremely good at doing? It's really good at identity and verification. It's also, the crypto market structure allows for incentivizing people to provide that data, to provide that verification. And so you have that system. My contention is that the market structure around crypto and the technology around crypto ultimately will be the way for AI networks to develop and flourish in an ethical and an honest fashion. Let that sink in. And let it sink in that we have no legal framework for that in the United States. And in fact, we're pushing it offshore. Do we really want to fall behind, both on the digital economy and in the AI revolution? I don't think so. But yet that is where this debate is going. And the Promethean thing just sent me right down these tracks because the public actually proved the point. Lastly, let's focus on the BlackRock ETF application because that is a very big piece of news. And let's talk about what does it mean. Well, first of all, let's understand who they are. They are one of the world's largest asset management companies. They understand what they are doing very well. And internally, they think this is an important thing to push forward with. And they think it's important for a variety of reasons. And it is important for adoption of Bitcoin and for the ecosystem, because to be honest, there are trillions, maybe even tens of trillions of dollars of wealth that are literally unable to invest in Bitcoin in their portfolios because of one of two factors. There are covenants governing RIAs, registered investment advisors, that prohibit them in many cases from trading with anything but listed instruments. There are other people who look at what happened with FTX and said, I can't afford for my assets to be stolen. I need something that I know to be safe. And the ETF structure does create safety for a variety of reasons. BlackRock has enormous numbers of amount of assets. They're significantly safer. And we see this with the gold trust. Now, I mentioned the gold trust, GLD, because it's a perfect analog here. And why the BlackRock filing is different is because they structured it almost the same as they structured GLD. Now, when you compare GLD to the Bitcoin trust, the difference is simple. Bitcoin as a spot product is dramatically more transparent than spot gold. It is dramatically more efficient to trade than spot gold. It is dramatically easier to surveil for manipulation than spot gold. I mean, there have been billions of dollars of fines for precious metal spot manipulation out there. That's public record. And the fact is that in the filing, BlackRock makes mention of the fact that Coinbase, who they're going to use for the accumulation and custody of the ETF assets, has already contracted with NASDAQ for their smarts platform to surveil for manipulation. There is no such thing as manipulation surveillance in the spot gold market. Try to buy gold from a dealer and you will see spreads upward of 6%, and you have no faith that what they're looking at as the spot market is what you're looking at, or anybody else for that matter. And despite the fact that there is a futures market in gold and there is a futures market in Bitcoin, the fact is both are spot ETFs. So that apples to apples comparison is extremely important. So we know that there's a lot at stake here. Now, can they jump the queue because they filed it this way and because they're BlackRock? I don't know. I am not a lawyer. Are they likely to be approved because of these reasons? Frankly, I doubt it. Because what we've seen, and it's funny because Gary Gensler has said it, and this morning on a Twitter Spaces, John Reed Stark, who used to work at the SEC and is obviously very well connected there, said it. What the SEC wants is nothing less than the commodity underlying ETFs to be regulated by FINRA and the SEC. Direct quote from Mr. Stark. Yet, of course, two things are true. Number one, there's literally no way for that to happen. Bitcoin is not under the jurisdiction of the SEC. And even if those exchanges submitted to surveillance, which they sort of are with the use of NASDAQ smarts and the ability to provide information, the fact is that they are not going to be broker dealers because the rule set doesn't work. You can't have on-demand settlement. You can't have multi-currency. We've talked about that. So even if Bitcoin were magically called a security, all that would do is shut them down. And that's the important point here. The second point is it doesn't matter because gold isn't traded on a FINRA regulated exchange in spot. It just doesn't exist. There's complete opacity in the spot market. And understand that the data in Bitcoin is public. And I can show anybody who wants to look what CoinRoute screen does. We are literally pulling in 10 plus terabytes of market data every day. At any instant, I can show you where the best bid is, where the best offer is, how much it costs to buy anywhere from $25,000 to $1 million of Bitcoin every second across these exchanges. And that information is publicly available. Sure, the SEC might not have the technology, and maybe they'll have to pay someone to do it like they do in equities because they pay vendors to do that. But the reality of the situation is there is a lot of transparency in Bitcoin. And this filing is going to expose a lot of the arguments the SEC has made as nonsense. So what's going to happen in the future? I don't know. But with a week with this much news and the narrative being fought, it becomes more interesting. The reality is different than the narrative. The narrative that is being pushed by the anti-crypto army is crypto is too volatile, it's unsafe, etc. And this week, it's really problematic for them because between the House putting forward that rule set, between a reasonable bipartisan approach to non-politicized SEC governance, and now the world's largest asset manager, or certainly the second, or maybe the second, I don't know who has more assets between BlackRock and Vanguard, but one of the world's largest asset managers putting out a proposal that has surveillance, that has equivalence to GLD, in fact, superiority to GLD, one of the world's largest ETFs. It's going to be really hard to argue those points. But as always, we shall see. In any event, I don't know if anything more will happen in the market. Who knows what will come out over the weekend, but enjoy your weekend. It's a holiday on Monday, and we'll be back next week. Stay safe out there.